48 hours ago, I told you exactly what was coming. I said silver would test $78, potentially flush lower, and then we'd see a violent rebound. I laid out the technical levels, I explained the manipulation mechanics, I gave you the entry plan, and it played out exactly as predicted. Silver hit $78.20 on the intraday low, tagged it perfectly, then reversed. Hard. We're now trading at $82 as I'm recording this. That's a $400 bounce off the lows in less than 24 hours. A 5% snapback after a 37% massacre. But here's the critical question everyone is asking right now. Is this the bottom? Is the rebound to $150 starting? Or is this just a dead cat bounce before another leg down to $70 or lower? Because what happens in the next 48 to 72 hours will determine whether you're looking at a generational buying opportunity or walking into a trap that will wipe you out. The technical signals are mixed, the fundamentals are screaming, and the manipulation is still active. If you want the exact playbook for what's next, the levels to watch, the catalysts that matter, and the precise entry and exit strategy, smash that like button, share this with someone who needs this analysis, and let's break down what's really happening. I'm Asian Guy, and this is the post-crash breakdown you need to see. Let me start by taking you back to exactly what I said 48 hours ago. I'm not bragging, I'm showing you the methodology so you can learn to read these setups yourself. In my last video I said, silver will test $78 to $80 support from previous consolidation. That's where the 50-week moving average sits. We could see a flush below to $76 and $77 to trigger maximum pain, then a reversal. What happened? Silver hit an intraday low of $78.20. It tagged the exact level I identified. It tried to break lower, hit $78, and then buyers stepped in aggressively. Within hours, we rallied to $80. By the next session, we pushed to $82. That's a $4 move off the exact support level I called. I also said, watch for a hammer candle or bullish engulfing pattern on high volume. That's your signal, the selling is exhausted. Look at the daily chart. Thursday's candle was a textbook hammer. A long lower wick showing rejection of lower prices. Small body showing consolidation. High volume showing institutional buying. Friday gapped up and confirmed with a bullish engulfing candle. The setup was there, the levels were precise, and if you followed the plan, you're sitting on a 5% gain from the 78er entry instead of panicking or sitting on the sidelines paralyzed. But here's the thing. Being right about the bounce doesn't mean we're out of the woods, because the next phase is even more critical. And if you get this wrong, the $78 entry becomes a $70 stop out. Let's talk about what this rebound actually means. From the $121 high to the $78 low, silver crashed 35.5%. That's the worst percentage drop since 1980. $40 in value erased in days. Over $2 trillion in silver market cap vaporized. The bounce from $78 to $82 is 5.1%. That's decent for a relief rally, but in the context of a 35% crash, it's nothing. It's a 12% retracement of the total decline. Historically, bear market bounces retrace 20-40% of the decline before rolling over. A full 38.2% Fibonacci retracement would take us to $94. A 50% retracement would be $99. So at $82, we're barely off the lows. This could be the start of a V-bottom reversal that takes us straight back to 100 plus. Or it could be a textbook bear market bounce that traps bulls before another leg down to $70 or $65. How do we know which one it is? We look at the evidence. And right now, the evidence is mixed, which is why the next 48 to 72 hours are absolutely critical. Let me lay out the bullish case first. Here's the evidence that supports the idea that 78 was the bottom, and we're beginning the rally back to 100 plus. Evidence 1, the Shanghai premium held firm. During the entire crash from $121 to $78, Shanghai spot silver never dropped below $118. Right now, Shanghai is at $120.30. COMEX is at $82. That's a $38.30 premium, a 46.7% markup. Not only did the premium hold during the crash, it actually widened. When COMEX hit $78, Shanghai was at $119, giving a $41 premium at the lows. That's a 52.5% markup, the highest premium in recorded history. What does this tell you? Physical buyers didn't panic, they didn't dump. They held firm and actually increased their bids. The crash was entirely a paper phenomenon. The physical market is completely disconnected from COMEX pricing. Evidence 2. Delivery demand accelerated. February COMEX delivery notices are now at 12.8 million ounces. That's up from 11.2 million last week and 9.4 million the week before. Despite the crash, or because of the crash, physical buyers are demanding more metal, not less. Wells Fargo issued 891 notices this week. JP Morgan issued 523 and stopped 678. HSBC issued 412 and stopped 589. These banks are frantically moving metal around. They're issuing delivery, they're stopping delivery, they're scrambling to manage exposure. That's not what happens in a bear market. That's what happens when physical is tight and getting tighter. Evidence 3. COMEX registered inventories fell to 36.2 million ounces. That's down 2.2 million ounces in 1 week. At the current delivery rate, COMEX has less than 3 months of deliverable inventory left. The drain is accelerating, not slowing. Evidence 4. The technical reversal pattern is textbook. Hammer candle on Thursday, bullish engulfing on Friday. Volume spiked on the reversal, confirming institutional buying. RSI bounced from extreme oversold under 20 back above 30. MACD is showing bullish divergence. Price made lower lows, but MACD made higher lows. That's a classic reversal signal. Evidence 5. The $78.80 level was the exact support I identified. It held. We're now above it. If this was going to $70 or $65, we wouldn't have bounced here. We would have sliced through like we did with $110, $100, and $90. The fact that 78 held and reversed suggests that it's where the major buyers stepped in. Now let me give you the bear case. Here's the evidence that this $82 bounce is just a relief rally before another leg down. Evidence 1, we're still below all major moving averages. The 50-day moving average is at 96. The 100-day is at 89. The 200-day is at 83. We need to reclaim these levels to confirm a trend reversal. Right now, we're just bouncing within a downtrend. Evidence 2, the volume on the bounce is lighter than the volume on the crash. When silver crashed from $100 to $78, volume was massive. Institutional selling. When we bounced from $78 to $82, volume was elevated but not as extreme. That suggests short covering and retail bargain hunting, not institutional accumulation. In healthy reversals, the buying volume exceeds the selling volume. We're not seeing that yet. Evidence 3, the government shutdown risk is still unresolved. Polymarket odds are at 89% for a shutdown by January 31st. That's tomorrow. If it happens, the immediate market reaction will be risk-off. Stocks down, bonds bid, dollar strength. Precious metals typically get sold in the initial panic phase. We could see another flush down to $76 or $75, even if $78 was supposed to be the bottom. Evidence 4, the bear market pattern is intact. We're in a lower high, lower low sequence. The high was 121. The next high will likely be lower, maybe 95 or 100. If we fail there, we make a lower low below $78. That's how bear markets work. One failed rally after another until sentiment is completely destroyed and capitulation is complete. Evidence 5, the macro backdrop is deteriorating. The stock market is crashing. The VIX is elevated. Credit spreads are widening. Corporate earnings are missing. This is not an environment where risk assets like silver typically perform well. The initial phase of a broader market crash is usually brutal for commodities, as everything gets liquidated for cash. Here's what nobody wants to hear but needs to understand. Both scenarios are valid. Both could play out. And the next 48 to 72 hours will determine which path we take. Scenario A, this is the bottom. We've established support at 78. The bounce to 82 is the first leg of a V recovery. We consolidate here for a few days, then break above $85, then $90, then $95. By mid-February, we're testing $100. By March, we're pushing towards Citi's $150 target as the physical squeeze intensifies and COMEX inventories hit critical levels. Scenario B, this is a bear trap. We bounce to 82's, $85, maybe even $88, trapping late bulls who think the bottom is in. Then the government shutdown hits, or another wave of selling pressure comes, and we crash through $78. We take out the lows, hit 75, maybe $72, and complete a full capitulation washout. Only then, after maximum pain, does the real bottom form and the recovery begin. Which scenario plays out depends on 3 specific catalysts that will resolve in the next 48-72 hours, and I'm going to tell you exactly what to watch. Catalyst 1, government shutdown deadline. January 31st is tomorrow. If a deal is reached and the shutdown is avoided, that's immediately bullish for risk assets. The relief rally accelerates. Silver could pop to $85 or $88 on the news. But if the shutdown happens, we get an immediate risk-off flush. Silver could drop back to $78, test it again, and potentially break lower to $75, $76. Watch the headlines tonight and tomorrow morning. If you see shutdown deal reached or funding bill passes, that's your green light for scenario A. If you see government shuts down or negotiations fail, prepare for scenario B. Catalyst 2, COMEX delivery data update. We're getting fresh delivery intentions Monday morning. If February deliveries jump from 12.8 million to 14 plus million ounces, that confirms the physical squeeze is intensifying. Bullish, silver rallies. But if deliveries drop back to 10-11 million, it suggests the surge was temporary and physical demand is softening. Bearish, we could retest $78. The delivery data is published daily on the CME website. Check it Monday morning before the market opens. If you see deliveries accelerating, that supports scenario A. If you see them declining, that supports scenario B. Catalyst 3, the $83 to $85 resistance test. The 200-day moving average sits at $83. We're currently trading right at it. If we can break above $83 and hold, that's technical confirmation of a trend reversal. Next target would be $85 or $88, the breakdown zone. If we fail at $83 and get rejected, that's a lower high. We would then likely retest $78 or break lower. Watch Monday and Tuesday's price action closely. If we open Monday and push to $84 or $85 on strong volume, scenario A is activating. If we open flat and can't break $83, or if we gap down on shutdown news, scenario B is in play. Throughout all of this, your North Star indicator is the Shanghai Premium. As I'm recording this, it's at $38.30, a 46.7% markup. As long as this stays above $30, the physical market is screaming shortage and the crash is paper manipulation. Here's what to watch. If the premium widens from 38 to 40 plus over the next few days, that's incredibly bullish. It means physical buyers are bidding even more aggressively. They're not waiting for lower prices, they're paying up. That supports scenario A. If the premium compresses from $38 to $30, $32, that's neutral. The physical market is still tight, but not intensifying. We're in a holding pattern. Could go either way. If the premium drops below $30 to $20, $25, that's bearish. It means physical is loosening, real selling is happening in China. The fundamentals are weakening. That supports scenario B and suggests another leg down. You can track this in real time. Shanghai Futures Exchange, silver price divided by COMEX front month futures. Calculate the spread, monitor it daily. It will tell you what the physical market is doing while the paper market is playing games. Let me give you the tactical playbook for both scenarios so you know exactly what to do. If scenario A activates, this is the bottom, entry. If we break above $83 and hold on Monday, Tuesday with volume confirmation, enter long at $83.50, $84. Your stop is below the $78 low at $77.50. That's a $6 risk. First target, $90. That's the previous breakdown support turned resistance. Take 30% profit here. Second target, $100. Psychological level and round number resistance. Take another 30% profit. Third target, 110, 115. Previous support zone before the crash. Take another 20% profit. Final target, let the last 20% run to 150 plus as if the city thesis plays out. Position size, use 50% of normal size due to volatility. This gives you room to add on a pullback if the move is confirmed. If scenario B activates, bear trap, entry. If we get rejected at $83 or $85 and roll over, or if the government shutdown triggers another flush, wait for $78 to break. Don't try to catch the falling knife. Let it hit $75, $76, then watch for another reversal pattern. When you see a hammer or bullish engulfing at $75 with volume, enter long at $75.50 to $76. Your stop is below $74. That's a tighter 2 to outdoors risk. Targets, same as above, $85, $95, $110. Then let it run. If you're short, if you shorted the bounce at $82, $85 expecting scenario B, your stop is $86. Take profit at $78, then trail stops lower if we break through. The key rule, don't fight the trend. If $83 breaks and we rally, don't stay short. If $78 breaks and we crash, don't stay long. The trade is the trade. No ego, no hoping. Execute the plan. Here's where we are. 3 takeaways for what's next. Number 1, the 48-hour warning was correct. Silver tested $78.20, bounced to $82 exactly as predicted. The technical reversal pattern is textbook, hammer candle, bullish engulfing, volume spike. But we're still in a bear market structure until we reclaim $85 plus in major moving averages. Number 2, the evidence is mixed. Bullish signals, 47% Shanghai Premium, 12.8 million delivery ounces, COMEX inventories at 36 million, and draining, technical reversal confirmed. Bearish signals, below all moving averages, lighter volume on bounce, government shutdown risk unresolved, macro environment deteriorating. Number 3, the next 48-72 hours determine everything. Government shutdown deadline tomorrow, COMEX delivery data Monday, $83, $85 resistance test this week. If we break higher, scenario A activates rally to 100 plus. If we fail and retest $78, scenario B activates potential flush to $75 before final bottom. The unresolved question, the unresolved tension. We bounced from $78 to $82 on textbook reversal signals. The Shanghai premium is at 47%, the highest in history. Delivery demand is accelerating to 12.8 million ounces. COMEX inventories are at 3-month supply and draining fast, but we're still in a downtrend. We're below major moving averages. The government shutdown could trigger another flush. The macro environment is risk-off. Is $78 the bottom and $82 the start of the rally to $150? Or is this a bear market bounce that will fail at $85 before another leg down to $75 or lower? The next 72 hours will give us the answer. Do your own analysis. This is not financial advice, but understand that we're at a critical decision point. The bounce from $78 to $82 is real. The reversal pattern is legitimate, but confirmation is needed. Watch the 3 catalysts: shutdown deadline, delivery data, and the $83 or $85 resistance test. If they all confirm bullish, scenario A is in play and you enter long. If they break bearish, wait for the lower low and enter at better prices. The 48-hour warning was right. Now execute the next phase with discipline, not emotion. The opportunity is real. The risk is real. Manage both. This is Asian Guy. The bounce is here. The battle is next. Trade the setup, not your hopes. I'll see you in the next one.